In episode 1, we diagnosed the investment portfolio problem. Typical high earner portfolio that's stuck in 3 traps: cash drag, tax drag, and fragmentation. Today, we do the part that usually changes the behavior. We run the numbers. 2 versions of the same person, same income, same savings rate. One stays trapped and one applies the system. Compound both for the next 20 years, not to prove a return forecast, but to show you the gap. So before we run the numbers, we need clear assumptions. I want this to be realistic, not optimistic. Let's take person A, Alex. They're aged 40, a shared household income of £250,000. They save about £3,000 a month after tax, and that's about £36,000 per year invested. They already have £200,000 in assets, cash plus investments. Nothing extreme, just typical for most high-earning professionals. The timeline: 20 years, age 40 to age 60. Now, let's run 2 scenarios. For our conservative assumptions, we assume equities return 6%, bonds 3%, cash 4%. And for the optimistic scenario, we assume equities return 9%, bonds 4.5%, and cash 4%. In both cases, we'll have an inflation assumption of 2.5% and everything shown first in nominal terms. And after that, we'll adjust for inflation so the comparison can be honest for the future values. What I want you to see today is the gap. And just to set expectations, in this model, the gap lands around £500,000. Now let's show you exactly where it comes from. The first version, the trapped portfolio. Same person, same habits, nothing changes. Their 200,000 looks roughly like this: 120 sitting in cash, 50k in a workplace pension, the default fund, about 30k accumulated in a general investment account, mostly ETFs that they heard about, no wrapper optimization, dividend funds inside a taxable account. They save about £3,000 per month, but half of it stays in cash. So only about £1,500 per month actually gets invested, and the rest just builds up in a safe cash pile. Now let's compound this for 20 years. In the conservative scenario, the cash grows slowly. 120k becomes roughly 160k in real terms, barely moving. The investment portion grows to around 580k. The pension grows to 140k, and the total wealth of this person at 60 is about £880,000. Now let's look at the optimistic scenario. We'll assume that equities perform close to their historical averages, and in this case, the invested portion grows to 780k, the pension reaches 175k, and the total wealth in the optimistic scenario is around 1.1 million. That sounds respectable until we compare it with the fixed portfolio. The exact same person, but they got out of the trap and they applied the system. They have the same income, same savings, and they started with the same 200k. The only thing that's different is that they applied the structure. Portfolio B, which was fixed. First change is they did the cash audit. They keep only 30k in an emergency fund. The remaining 90k gets invested gradually over 6 months, and the money now compounds instead of sitting idle. The second change they do is the wrapper strategy. They maximize their ISA allowance every tax year. They optimize their pension contributions to use tax relief, and the remaining money goes to the general investment account with tax efficient holdings. The third change they apply is to have a pillar structure. The portfolio is organized around clear rules, quality growth, structural sectors, real assets, bond ladders, quality financial. And the fourth change is they rebalance it quarterly. Only 20 minutes, that's it. The biggest difference, though, is something most people underestimate, and that's the cost drag. The trapped portfolio loses roughly 1.2% a year to fees, tax leakage, and idle cash. The fixed portfolio reduces that to around 0.4%, and that 0.8% difference doesn't really feel dramatic, but over 20 years, it's enormous. So here's the mental model. A 1% drag on returns over 20 years can reduce your final wealth by 20 to 25%. And that's why small inefficiencies matter a lot more than most people think. If your portfolio ended up £500,000 smaller than it could have been, would you even notice early enough to fix it? The thing is, most people don't because that leak is silent. Let's run the numbers. For the fixed portfolio, in the conservative case, it reaches £1.35 million. And in the optimistic case, about £1.8 million. Same person, same effort. The only thing that changed was the structure that they applied. Now let's put both portfolios side by side. In the trap portfolio, we ended up with 880k to 1.1 million. Seems decent, but with a few small changes, the fixed portfolio ended up with 1.35 to 1.85 million. And the difference between 470 to 750,000 pounds. Same person, the same income, no extra risk, no genius stock picking, just 3 improvements. Investing the cash, using tax wrappers properly, and reducing drag through structure. Cost of doing nothing is about £500,000 to £750,000, and that's the price you pay of staying trapped. Now let's adjust that for inflation. In today's money, the fixed portfolio still ends up with around 850 to 1.1 million. The trapped portfolio, roughly 550 to 690k. Even after inflation, the gap remains huge. What does this gap mean? Numbers might be abstract, so let's translate the gap. What 470 to 750,000 pound buys, it can mean retiring at 57 versus retiring at 75. It could mean the difference between helping your children with a property deposit or not. And it can mean genuine flexibility in your 50s. The cause of that difference is just having proper portfolio hygiene, structure, discipline, consistency. Those are boring ideas, but boring is what compounds. Some of you are thinking, I understand the system, but I don't trust myself to maintain it. My investment portfolio is public on eToro for the last 10 years. You can see every position, every pillar, every rebalance in real time. And if the logic makes sense, but implementation feels like a lot of effort, you can simply copy the portfolio. I'll drop the link in the description below. Simple systems are the ones that people actually follow. Let's recap on the series. In episode 1, we diagnosed the traps: cash drag, tax drag, and fragmentation. They all stumble high earners. Episode 2 built the system: cash audit, wrapper strategy, and pillar frameworks. Finally, in this episode, we showed the projection, the cost of doing nothing, 470 to 750,000 pounds. And now that you've seen the maths, the question is simple. Will your portfolio compound with structure, or will you let it drift without it? If this helped you, feel free to subscribe, because I'll keep breaking down the financial decisions that high earners get wrong the most often. If you want to see the system running with real money in real time, check out my portfolio link below.